Welcome to The Rubber Meets the Road Economics, the podcast where we explore the driving forces behind today's economy and their real-world implications. Join investor Hunter Craig as he interviews Professor Edwin Burton from the University of Virginia, delving into the complexities of economics with clarity and insight. Whether you're an economics enthusiast or just curious about how economic policies affect your daily life, you're in the right place. Let's get started.
Welcome to Rubber Meets the Road Economics with Professor Ed Burton. Today is January 8th, 2025. Professor, wild swings in yields on the U.S. Treasuries. 1 month, 10-year, 10 years rising, 4.68%. What drives interest rates?
Well, supply and demand drives almost everything that has a price on it. And interest rates are essentially an inverted form of the price of a bond or a Treasury bill note or anything else. So the tremendous supply of Treasuries that hit the market this week, there was $110 billion of extra Treasuries in the form of a 3-year note auction, a 10-year note auction. And today they're going to be auctioning the 30-year bond. And those yields have just escalated like crazy. The 30-year bond might push through 5 today. And if so, it would be the first time in a long time we saw 5 handle on the 30-year. So supply and demand, this is happening globally, by the way. The same kind of analysis with different numbers could be said for Japan and the United Kingdom and most of the countries in the Eurozone. Everybody's facing much higher rates of financing.
What happens to real estate in a period of rising inflation? Does all real estate appreciate in value in rising rates?
Well, almost everything in economics depends on whether it's expected or not. If you're in an inflationary environment and you expect it to continue, you have all kinds of ways to protect yourself. In commercial real estate, you can put escalator clauses in on rent compared to inflation rates, and people do that. You can even protect yourself against unexpected interest rates in some of these leases, as you know much better than I know. As long as it's expected, as long as you have reasonable expectations. And what are those right now? Well, it's probably reasonable to assume that inflation will be 2.5% to 3% over the next year or so, barring something unusual by the Fed. And it's probably reasonable to assume that we're not going to see a whole lot lower rates than what we're looking at right now. I think that's a reasonable assumption. Once people expect that, and if it turns out to be true, then you can always take care of it. What hurts with rates and inflation is when you don't expect it. You do it, you go into something at a 3% yield, for example. You say, hey, I'm going to finance this at 3%. This is like a great project, and the P&L is terrific at 3%. And then when you go to refinance it 5 years later, it's 9%. This is what's happening in the private equity market today. Then all of a sudden, there's an extra 600 basis points of expense that you never thought you'd be facing. That's when higher rates really make a big difference. If higher rates are expected, if the rates just keep climbing by 1% or so and they're expected, that's one thing. And what's happened here is that we've had a lot of myths about rates. One of the most popular myths is the idea that if you have interest rate inversion, that is, if short yields are much higher than longer yields, you'll have a recession. It's a recession predictor. So back when we had inverted interest rates, when short rates, overnight rates were much, much higher than 10-year and 30-year rates, which they were just 3 years ago, everybody predicted recessions. We had recession predictions going every single year from 2021 to 2024. Recession never came. But that was an old wives' tale. There's not a logical reason to expect that to happen. And so you're going to hear, as rates keep bouncing around, all kinds of, particularly out of the hedge fund world and other similar folks who like to talk a lot about what's going on, you're going to end up hearing a lot of predictions, a lot of statements like this is a killer or this is the peak on this or that. Nobody knows all those things. All we know is that supply and demand ultimately is going to be the problem. And if the supply of U.S. Treasuries keeps increasing, like it is, we're going to have higher rates.
Professor, when you say supply is growing for Treasuries, is that because the U.S. government has ever-increasing and massive borrowing needs? And what's your estimation of demand? Remaining the same, increasing or decreasing on demand from China, Japan?
Well, demand can change quickly in the Treasury market. That's something people don't seem to understand. For example, the reason Japan and China have bought an enormous amount of Treasuries, they each own over $1 trillion each in Treasuries, And the reason they hold them and don't sell them is the dollar's done so well. So if you're sitting in Japan and you own a 30-year Treasury bond and it's down 4% this month, the dollar may have gone up 4% to offset it. After all, you're yen denominated, so if the asset's a dollar asset and it goes up in value, that's great for you because that'll create more yen, which is what you want. So what happens if that changes? What happens if all of a sudden the dollar starts weakening? Well, Japan may decide maybe we can put 100 billion of these treasuries out in the marketplace. Well, that would be a disaster for the weekly auctions. Remember, every single week the U.S. Treasury is auctioning treasuries. They're raising money every week. Not a week goes by. Mondays, they sell Treasury bills. Tuesday, they sell Treasury bills. And the rest of the week, they're selling longer dated paper. Sometimes it's 2 years and 5 years. Sometimes it's 3, 10, and 30, which it is this week, for example. This is a drumbeat that never stops, and they're getting bigger and bigger. The size of these auctions is getting unbelievable. So what could cause a problem? Well, almost anything. A stock market sell-off would make the country less wealthy. That would trigger problems in the debt market, just as problems in the debt market create problems in the stock market. They kind of work on each other. We're used to the idea if the stock market weakens, the debt market will get better. But I think that old song won't play anymore. If the stock market weakens, the debt market could get worse. You might have a reduced demand for a lot of the longer-dated treasuries.
Reduced demand would dictate that the government has to offer a higher rate in order to attract investors?
That's correct. Don't forget that we've sold Treasury bills at coupons of 14%. The 30-year Treasury, which was auctioned in 1981 in August, was the 14s of Novi 11. That's what they were. They were auctioned in November of 2011. It came at a 14 coupon. In other words, for every $100,000 that you bought, you got paid $7,000 twice a year. You made $14,000 every single year on a $100,000 bond. And by the way, that bond lost 16% of its value within the first 2 months. The highest yield on the 30-year Treasury was 16.8%.
Were there many investors who bought the 30-year bond and held it for 30 years?
Well, my grandmother did. That's the famous story where my grandma bought the 30-year bond. But it was scary. But one easy fact about buying something that has a 15% yield is the duration is actually a lot lower, which means the risk of owning a 15% piece of paper is a lot lower than the risk of owning a 1% paper. It's just the mathematics of the duration risk. So as yields go up, your risk of owning these securities gets lower. The problem is if you already own them, you're drowning as rates go up because their price is falling. And that's what's happening now. Anybody that bought a 10-year auction just 3 months ago, you can do a pretty simple calculation. The duration on a 10-year is a little over 8%. Well, if you bought this thing and it's up 50 basis points, you lost 4%. So if you bought 100 million of this, you now have $96 million in a market where the stock market's on a tear. And you bought what you thought was safe and lost 4% of your money. Duration is a serious risk. It's worse with the long bond. Now, the 30-year Treasury has a duration of roughly around 20. So if you bought that last year and now you're staring at how you stand now, you're down 10% in just this year on your 30-year bond. That's how risky those pieces of paper are. Well, people get nervous about owning stuff like that. You take a bunch of losses like that, and then you say, oh, there's another auction coming. Fine, I've got to play golf. I won't have time to buy any of that stuff. I'll find something else to do with my time. And that's when life gets dicey because the government needs to get these fundings done. For example, when this week is over and we've stuffed all these 10-year and 30-year bonds in people's portfolio, next week it shows up again Monday, and we'll have a wampum amount of Treasury bills to sell. Someday the buyers will not be there. And what that means is they can get them there. You can get buyers. All you have to do is change the 4.3 yield in the 3-month Treasury to 6.3, and you'll have all the buyers you want.
What's the highest you've ever seen Treasuries go up in a day or 2, 3-day period?
I think 300 basis points was the highest move. The highest value was pretty close to 17%. That was back in the days when the prime lending rate was 22. Now, you have to be pretty old to remember this because that was in 1980-81 when 81 was really the peak in rates. And what was that? That was 44 years ago. So a lot of our traders in Wall Street are 40 years old. They think rates can't get higher than 6 or 7. They think that's the peak. Well, that's what we thought back in the 70s. When we entered the 70s, rates were around 3 or 4%. When we exited, they were close to 20. When we entered the 60s, the unemployment rate was 3%. By 1981, the unemployment rate was 10.8, the highest rate since the Depression. When we entered the 1970s decade, the rate of inflation was 3%. In 1981, it was 14%. 14%.
Federal Reserve next meets January 28th and 29th to set the target rate for federal funds. The yield on the 1 month today is 4.29%. What will the Fed do in the end of January?
Well, if it was today, they wouldn't do anything. But if we get close to the date, let's say it's 3 or 4 days before the Fed's going to act, we just look at the 1 month, 2 month Treasury bills. If they're below 4.25, then I guarantee you they will act. They will cut the rate 1/4 point. If they're above 4.25, they're not going to do anything. That rule has worked perfectly for many, many years. And certainly as long as this podcast has gone on, we haven't missed a single call on the Fed, and we won't. So if it was this week, they wouldn't do anything. But they're close enough. One thing that could happen, for example, if the stock market struggled enough, there would be a flight to quality, and it would show up in the bill market.
Professor, you've used the term flight to quality several times. Can you tell us what you mean by that?
When you're scared, you want to put your assets somewhere where there's no risk. Now, the risk in the bond market is twofold. Either a credit risk, you don't think people will pay you, or a time risk, which is called duration. If you buy Treasury bills, there is very little duration and no credit risk. The government is going to pay you off. When assets get scary, when the stock market starts weakening or any market gets in trouble, real estate market, whatever it is, people will move their assets toward Treasury bills because that has the lowest risk, and that's a flight to quality. Treasury bills are quality because they don't have these risks.
And what's the difference between a bill, a note, and a bond?
A bill is anything the U.S. government auctions that has less than 1 year in maturity. And the primary bills are the 3, 6 month, and the 12-month bill. Although they have been auctioning 1 month bills quite a bit just the last few years. Anything over 1 year is a note or a bond. Now, there's really no difference between a note and a bond. The formal difference is a note is anything with 10-year or less original maturity. But otherwise, they look the same. They pay 2 coupons a year. They pay principal at the maturity date and so forth. And a bond, there are only 2 bonds actually in existence these days. There's the 30-year, which everybody talks about, and the 20-year, which is being auctioned again. So there's the 20 and 30. That's the only 2 denominations. And in the note market, the denominations are the 2-year, the 3-year, the 5-year, the 7-year, and the 10-year. So a flight to quality. So if you had the stock market sell off 20%, say, between now and 28th or 29th, I'm not predicting that, but if that did happen, you'd probably see bills dip below 4.25. And then the Fed would act, and everybody would say, oh, the Fed is acting to protect the markets. No, the Fed is acting to protect itself. If the Fed doesn't do anything when yields go down to 4.25 or 4.20, then the next time there's an auction, everybody's going to do repos, not buy the auction, and the rates will come back up, which they don't want. So people attribute too much power to the Fed. The Fed is not a major player. What's a major player in this area and really everything else is supply and demand. If you want to know why a price changes, the first thing to consult is supply and demand. This is why they don't understand inflation. What causes the price of money to change? You might consult the supply and demand. We increase the supply 50%. If you increase the supply of peanuts by 50%, you held everything else constant, what do you think would happen to the price of peanuts? You think it'd go up? No, it'll go down, and that's what happened to the price of money. It went down, and that, by definition, is inflation. And what's happening in the debt market is not all these other things people talk about, rising inflation expectations, big stories in the Financial Times and Bloomberg and Wall Street Journal about that today. That's not what's going on. What's going on is supply and demand. We have a huge amount of supply. And demand is kind of where it was last week. It's not jumping as fast as the supply is. So what's likely to happen? What's likely to happen is we're going to see much higher rates. No one is good at predicting rates, and I wouldn't pretend that I am. I certainly didn't predict this big surge, But I think it was definitely possible, and I think it wouldn't surprise me if we were staring at 6% this time next year, and all of these markets are even 7%. And now everybody says 6% on the 10-year, 7% on the long bond. We've never seen rates like that. Oh, yeah, we have. Historically, that's more likely where the rates have been, not these 1.7% numbers that we saw 5 years ago. Those were the anomaly. There's nothing wrong with 5-6% rates if they just kind of stay there. The problem is you always have the fear when they get there that they could go higher. That's what scares people. If we live with 7.5% mortgage rates, for example, let's say over the next year or two, mortgage rates don't do anything. They just stay at 7.25, 7.5. You'll see a housing market recovery. People will buy houses, and you might say, well, they're unaffordable. No, not really. And you'll be surprised how people will do that. I mean, we saw the same phenomena in the late 70s when people were taking out 18% mortgages like they were absolutely nothing. Imagine an 18% mortgage. That's what they were. Mortgage rates never got below 12 until 5 years later. And that didn't slow people from buying houses at 18% mortgages. Hunter, you're not old enough to remember that, but I am. I took out a 16% mortgage to buy a home. I remember in Milford, Pennsylvania, 16%. I thought I was lucky to get it.
You were happy to get the mortgage.
Oh, absolutely happy to get the mortgage. So the world's not going to come to an end if rates are higher, but it'll slow growth in the country. High rates, President Trump's right. High rates aren't good for growth. But on the other hand, there's not a lot he can do about it. He can exhort the Fed, but the Fed long run doesn't control it. If it tries to intervene by buying the auctions, which is what it has been doing in the past, entered the auctions dramatically from 2009 to 2019, then it'll just cause inflation. And if inflation takes off, rates will follow it. That's what happened in the 70s, and that's actually what happened in the last 5 years. Inflation went up and rates followed it. And if you didn't have a central bank, that would have happened, even if there was no Fed. It didn't even exist.
So the Fed could move rates by using their balance sheet and purchasing Treasuries, but they have to publish that data, don't they?
Yes. The Fed publishes, there are two numbers if you want to follow Fed activity that you should look at, and they're easily available. One is go to the Federal Reserve website, or might go to the St. Louis Federal Reserve because they have the best data, and look at their balance sheet. In other words, what are their assets? Now, that is not a complete guide. And the reason is the weird balance sheet treatment of repos. Repos should be treated as assets, but they're not. They're treated as net liabilities on the liability side. So you've got to go look at the M2 money supply. And to find that, you can go to the same St. Louis Fed and say, what is the M2 money supply? And they'll show you charts. It's currently growing about 1% a year. That's kind of where it is, which is why inflation has been slowing. It's not going to zero, but it's been slowing. But that number was over 50% increase in 18 months back in 2020-21. That's what caused the inflation, the huge increase in the money supply. So markets tend to work. One of the things I think that is not apparent when you watch the financial news and read the financial publications, people have all sorts of non-economic reasons for making predictions. The simplest answer is supply and demand for anything. You want to know why home prices are going up? Home prices are going up because demand exceeds supply. It's just that simple. So the interesting question is, what are the determinants of supply and demand? Those are the things you want to think about. And I think in the debt market, that is the easiest thing in the world. Not only have sovereign countries gone to the markets, sold unbelievable amounts of debt, not just the U.S., United Kingdom, Eurozone, Japan, China, everybody, India, you name the country, they have flooded the market with sovereign debt, government debt. Sovereign means government debt. But it's not just that. Last year, we had record corporate bond issuance in America. Somebody thinks rates might go higher, or they wouldn't be borrowing an unbelievable amount of money in the corporate bond market. You had a record month in the United Kingdom just last month of corporate bond sales. All over the world, people are rushing to get more debt on the books. Why are they doing that? Well, one guesses they probably think rates are going higher. Otherwise, there wouldn't be any big hurry to go take on more debt. So we have a debt time bomb. Question is, when does the bomb go off? And this week has been a little bit of a scary week because what you saw in the 10-year and 30-year, that could be a harbinger of what's to come.
Professor, thank you. The Fed meets in 3 weeks from today, and we want to hear what you have to say. We'll have a podcast just before that meeting. But today's been one of the best, if not the best, podcasts we've ever had because we have 2 special guests today, the great Stuart, the great Robert. They're your grandchildren. What's their world going to look like in 20 years?
It's so great to have these two. I'm so lucky to have Stuart and Robert as my grandchildren. What can I say? I think they're going to inherit a great world. I'm optimistic. I think you'd always take a negative view and see all the negative things going on out there, but you can also retell the story with the same set of facts in a positive way. And I think I've always been an optimist. I may sometimes predict markets are going to go haywire, but in my everyday life, I'm an optimist. I think life has been good to me. I've been very lucky. I'm probably the luckiest person that walks the earth. I think things look good in the future, and I think these boys are going to have great lives. They're good boys, and they deserve great lives.
Thank you, Professor.
Thank you, Hunter.
Thank you, Robert. Thank you, Stuart. Thanks for being here.
Thank you for joining us for the Rubber Meets the Road Economics podcast. If you enjoyed the discussion, remember to subscribe and stay updated with future episodes. Join us soon for more conversations about modern economics on the Rubber Meets the Road Economics podcast.